Welcome back, everyone, to Crystal Gazing 6.0. It's been a fantastic day of discussions and insights, and we've saved a truly forward looking session for the last. Our final topic for the day is tomorrow's multi-bagger alternative strategies. As markets evolve and new opportunities emerge, the hunt for the next multi-bagger investment continues to intrigue investors. With 2024 marking the highest number of investors in the history of Indian equity markets so far, the hunt for multi-baggers has grown exponentially. In this session, we'll explore how innovative alternative strategies, pre-IPO investments, distressed debt, and private equity are shaping the future of wealth creation. Our speakers will share their expertise on identifying game-changing opportunities and strategies that deliver a higher alpha for investors. We're indeed honored to have a distinguished panel of industry leaders joining us. Our panelists are Mr. Nishad Khanolkar, President, Bharat Value Fund, Pantomath Group. Mr. Nishad is a seasoned finance professional with over 24 years of experience in asset management, private equity, M&A, and investment banking. He's a chartered accountant and a member of CPA Australia. Previously CEO of SP Growth Partners, he plays a key role in launching SEBI-registered Cat 2 funds, including Bharat Value Fund, managing over rupees 5,000 crore across 3 series. Now, we have our next panelist, Mr. Umesh Agrawal, SEVP and Fund Manager 361 Asset. And Mr. Agrawal brings more than 25 years of experience across equity capital markets, private equity, and M&A. At 361 Asset, he focuses on investment strategies for pre-IPO and late-stage private equity opportunities, having completed over 90 landmark transactions and channeling billions into emerging corporates. His deep knowledge of structuring high-growth investments makes him an invaluable contributor to this discussion. We have with us Mr. Viki Badani, Fund Manager, Whitespace Alpha Special Situations Fund. Mr. Badani, a seasoned finance professional and CFA charter holder, has over 15 years of experience across corporate finance, distressed debt, and private equity. With expertise spanning global debt markets, M&A, and SPAC transactions, he has a unique perspective on identifying and structuring alternative investment opportunities. Mr. Viki's career trajectory reflects a deep commitment to delivering value in dynamic and high potential sectors. And those were our eminent panelists. This session will be moderated by Ms. N. Mahalakshmi, Senior Consulting Editor, Money Control, who also moderated a session early this morning. Ms. N. Mahalakshmi, a seasoned financial journalist with over 25 years of experience as a senior leader at Network 18, heading markets and economy coverage at Money Control. Previously, she served as editor of Outlook Business and Outlook Profit and Led Markets and investing coverage at Business Standard. She holds the rare distinction of being among the first Indian journalists to interview Warren Buffett, along with other global investment icons like Howard Marks and Joel Greenblatt. Ms. Mahalakshmi, it's over to you.
Thank you so much, Aishwarya. This is an incredible opportunity and an incredible session. Thank you, Kamal, PMS AIF, for this opportunity. This is one session I think I don't have to really do much at all, because the three speakers that we have for this panel have three distinct alternative strategies, and all we have to know is how do they go about picking whatever securities they do. What is their thought process, and how do they do it to ensure that you are able to deliver better returns, whether it is risk considering the asset class they invest in. And first, let me sort of pose this question to Nishad, who invests largely in pre-IPO kind of companies. Nishad, please tell me, we've seen a 20% correction. There seems to be a visible change in the sentiment in the market. What does this mean for the kind of funds you manage and the strategies that you pursue?
Thanks, Ms. Mahalakshmi. First of all, nice speaking to you after exactly 1 year. Last year on the same platform, you had interviewed me. So really nice. And thanks to Kamal and his entire team for giving me this opportunity. So right now, directly coming to answer your question, I'd like to give a 1 or 2 sentences about what exactly the fund we do. So that would help me in answering your question in a much better way. So we are AIF2, in a simple way, unlisted to be listed. The one-line theme of my fund is very clear. Invest in those companies which are IPOable in next 2 to 3 years time. Because the segment that we work one thing is very clear in our mind. Most important factor in my segment is exit. Exit is the most important factor in life. So we only invest in the exitable opportunity. So we always believe that there are various stages of investments, but if you invest in substance, then returns are going to come. So for example, what we have done, for whatever money we have invested till today, 97% money we have invested as a primary capital. So what is primary? Primary is a growth. So when you invest primary, the balance sheet size means the revenue, profitability of the company increases. If the profitability of the company increases, valuation is secondary. Balance sheet size is primary. Invest the
Hmm.
primary. So rather than giving a secondary money, we are given primary. Most of the money we are invested are in the asset-backed companies. So where the substance is there. Most second important is a profitable company. The 92% of the fund invested by us till today is in a profit-making company. So when the situation gets tough, so instead of, I believe my third fund was launched in the month of December, where unfortunately my fund launching and the market correction happened at the same time. It was not
Right.
planned. So it was, we most of us will thought that it was a tough situation, but in tougher market also we could garner more than 1,500 applications and sorry 1,500 crore of fundraising and more than 800 applications within a span of 60 days. If
Hmm.
that can happen, if you talk about the substance and not only about the valuation, and that is the core crux of our fund, that invest in those companies which are IPOable in next 2 to 3 years times. No freebies, only and only where we see a growth potential, there only we are putting our money. So that has
Hmm.
been the success ratio of fund one and fund two, and same we are translating into the fund three also.
Hmm. Hmm. So coming back to the question I asked, which is that today there seems to be, at least compared to what we have seen in the last, our reference is only post-COVID period. But people like me who've been in the markets, at least covering markets for 25 years or so, will know that this is no correction at all. We've seen worse. We've seen 50%, 60% cut in markets. But there seems to be a lot of fear, and of course foreign investors are selling, but there seems to be a shift in sentiment, and it's scaring people away. Now, usually when market sentiment turns, the first casualty is primary markets, because everybody who wants to go IPO doesn't get the kind of valuation that they are expecting. Promoters, are unwilling to IPO. The selling shareholders may not be prepared for the price that they were anticipating. So, in your perception, is this phase something that is passing from IPOing companies or pre-IPO strategy perspective? How do you look at the situation?
So coming back to the IPO experience, as a Pentomath group, the group has executed 112 IPOs in last 10 years. So that is practically one IPO per month. So I believe the worst year or financial year in last decade was 2018.
Hmm,
2018 was the worst year, and 2018 also we have seen good IPOs coming. So my
hmm,
answer still remains the same. Cycles will come and go. We can only predict the cycle. Catching the cycle is relatively tough. But if
hmm,
you
hmm,
have invested in good quality assets at a substantial, I will not use the word lower valuation, that is a wrong statement to do, but at a
hmm,
good market valuation, then whenever the
hmm,
situation improves this, you are the first person to get out. What I
hmm.
mean get out is you are the first person to get exited. So basically when the market gets tough, the freebies gets the first hit. And a
Right.
typical asset backed PAT positive companies where promoter having substantial shareholding, they are the last people to get the hit. And at the same time, when the situation improves, they are the first people to get the benefit. So that is how the quality of the assets really gets determined when you, if based on what kind of a quality investments you have done. So that is the reason
Yeah.
always stick to the principles, and that is what we have stuck to our principles.
Sure. Nishad, we'll come back to more questions. I have more questions for you. But before we do that, let me get Viki in. Viki, you seem to be in a sweet spot right now, because all the equity investors are getting rattled, and when usually they get rattled with debt, they run away to when they get rattled with equities, they run away to debt. So, how is your asset class, and how are your strategies looking in the current circumstances?
Hey, hi. So I hope I am audible. I have some issues
Yes.
with my
You
camera.
are, you are, you
Yeah,
are, you
great.
are audible.
All right, right. So Mahalakshmi, I hope when you were referring, you were not referring to my personal portfolio. when you're saying that the equity downturn obviously had an impact at the personal level. But yes, you are very correct. This the run up that we had seen in the equities was kind of going to a level where people were forgetting the asset allocation and the importance of diversification as we speak. So given the current uh, volatility that we are seeing, there is a good chance for investors to reallocate, to introduce some bit of debt in their portfolio. And where my fund is different from your traditional debt products is that my fund offers a combination of debt as well as equity. So, where Whitespace Alpha Special Situations Fund differs from your traditional debt allocation is that you are entering with the mindset that there will be some debt component to the investment which will keep returning certain cash flows to you on a periodic basis. And there will also be the upside that will come about when the thesis by which we've invested actually plays out. And in that 3 year, 5 year, 7 year investment horizon, you will actually see the equity investment generating the kind of returns that you were hoping to when you invested in
Hmm.
us.
Hmm.
So yeah,
And
so
yeah,
sorry,
sorry,
no.
please go on.
So
Please go
just
on.
to conclude, yes, we are seeing a pickup in the interest given the volatilities. I'll not say that I hope this continues, but I hope that people do evaluate their portfolios seriously from the perspective of diversification and do give debt their rightful place in
Right.
their portfolios.
Right. So my question was, so I was referring to the private credit fund that you look after. How
Right.
is that space looking in this environment?
Right. Uh, So private credit essentially is, banking. I'll not say banking the unbanked. It is kind of taking punts or taking risks where your traditional banking is not helpful. So any time that you would approach your traditional banking partners and they are either too defensive on banking or backing your particular call is when you try to tap into the private credit markets. Now, private credit markets, in its essence, is a combination of performing credit as well as distressed credit.
Right.
Performing credit, we all understand, is companies that have great cash flows, that have great ratings, and they are well covered with their traditional banking partners, but they have certain requirements which these banking partners are shying away from, which is where a private credit fund steps in. Obviously, because of the risk element involved, the pricing also is slightly better than what you would typically get from a banking product. When it comes to distressed market, the distressed credit investing space is an altogether different animal. Here you are evaluating lots of opportunities where there was some potential in the company at some time in the past, and perhaps in a mix, due to a mix of factors, the company is facing the current situation that it is in. That actually gives us a great opportunity to enter into the company, to set right certain things, and then see the whole thing correct and the valuations come along. So that is how the whole private credit space works, that you are investing with an element of debt first, with the potential to have an equity upside once your particular investment thesis is played out.
Sure. Sure. And normally, what is the kind of return that you target for this fund?
So, depending on the kind of investment or the kind of allocations of debt and equity you would see in this thing, the pre tax returns typically range from 22% plus. In our fund, and we have seen that in the past as well, in certain investments that we've done from a prop book, we've seen IRRs exceeding 30%, and they are possible with the right combination of debt and equity. So as a fund, we've been uh, looking at investments, or the only investments that we onboard are ones that have the potential of delivering 30% plus kind of IRRs to us.
Hmm. But 30% kind of IRR in a fixed income, predominantly fixed income product, how do you straddle the risk?
So look, the basics of private credit investing involves 4 C's. You have your cash flows, you have credit, you have collateral, and then you have covenants, right? Credit is something that is currently under stress right now. You are hoping that, and that is where the evaluation comes in. That is this a sunset business, or is it a sunset industry, or is it a great business in the wrong, at the wrong time? If it is a right business in the wrong time, you would want to back such a credit. Cash flows, it has to have enough cash flows to be able to return your capital. The collateral is kind of the downside protection. The governance is what will instill the financial discipline into the company. And once you have all of this coming together, what will happen is that the equity investment, or the value of your equity that you have invested, will give you multifold returns. So the debt element will be a standard 18% to 22% kind of a coupon, because you cannot load more than that, otherwise the whole business will just subside. So that's why what you're hoping is that the valuations at which, or the multiples at which you would have invested into the company, would grow multifold once the business has right sized, once uh, the operations have stabilized, and once the theme is played out. So over a 5-year horizon, you would see the value of your equity investment growing 3x 4x, which kind of aggregates to a 30% return overall on your investment.
Right, right. So again, I have more questions on that, but let me first get Unmesh. Unmesh, you predominantly invest in pre-IPO and late stage. First of all, tell us your strategy, and under the current circumstances, how do you see these strategies working out over the next 3 years?
Yeah, hi. Thanks, Mahalakshmi. So we look at any investment in a company which can IPO, say 1 month to 4 years from the time that we invest. So which means that we also look at post-DRHP situations, and we also look at late-stage growth situations which can IPO in the next 3 to 4 years. So we have essentially three pillars or three filters. The first is growth. We predominantly look at only those companies in which are growing faster than their industry. Okay. To put some number to it, we need a minimum of 15 to 18% growth in revenues as the first filter, and in a large total addressable market, or the TAM as we call. So that is, and the revenue growth should also result into a doubling earnings in the next 3 years. Okay, so this is the first filter, that you should be growing faster than industry in a large market with doubling revenues and with doubling earnings in 3 years. The second important filter we have is a limited peer set, meaning when this company goes to the market, at that time, there should not be like dozens of companies which are very similar to this company already listed, because the market likes something new. Naya kya hai? Is company mein naya kya hai? That is the question, right? So we try to look for something unique. Now that uniqueness could be in just a new business, okay, or it could be an age-old business but with a very differentiated business model. So something which is new or different. That is something we really focus on. The third and the most important is the pricing discipline. Here, since we are late stage, pre-IPO, and IPO is our primary source of exit, we tend to get pushed by issuers and bankers to look at comparisons to public market multiples, right? But we keep reminding ourselves and to the companies that, look, this is a private company, and there is all the risks of IPOs, getting delayed, etc. So there has to be important 15-20% illiquidity discount. Okay. So pricing discipline, and coming to your point of what is happening right now in terms of softness in the market, actually is fantastic for us, because the pricing is getting sensible, is getting better. We are already seeing at least a 10 to 15% correction in ongoing transactions. Okay, in some exceptional cases is even higher. And we are also seeing good companies saying, okay, I don't want to do such a large IPO transaction at these lower valuations. Can we do a private deal? So we have the flexibility to go from 100 crores to 500 crore of deal size. And we are seeing at least one company or one transaction right now, which is moving from an IPO to a private deal. For me, also the deal size is shooting up from 100 to 400 crores, and the company will relook at IPO after 2 years. So,
Okay.
so current market
So you're saying your playing ground is essentially widening.
is widening. Yeah. So we
Okay.
are actually in a way happy that there is some sensibility coming in the pricing.
Okay. So, which also means if your deal, playground for deals is widening, doesn't it also means that the playground for IPOing companies is shrinking?
You can say that, but
Which means a problem for exits.
not really. So for example, this one specific deal I talked about. Of course, I'll not get into the details of the deal, but the deal was a 700-800 crore IPO, and it is moving to 400 crore of a private deal. So where there is some primary and some secondary happening, right? So the deal size is shrinking, but the company is getting at least part of the capital it wanted, and some private equity is at least getting part of the exit that it was seeking, and they will relook at the IPO in 1.5 years or 2 years. So and this is it's temporary. See, earlier in the 2010 to 14, there were only 3 or 4 IPOs in a bad year, and then the market turned. 2017 saw 50 IPOs, 18 saw very few, but now these cycles are becoming shorter. So markets they will shut for 1 or 2 months and they will come back. We saw a blip in September, we saw a blip in March of 24, we saw a blip in November 23. So these cycles are becoming faster and shorter.
Sure, sure. So, Nishad, I'll come back to you. In terms of pricing environment, I mean, last year was great for IPOs, and this year, I think, barring January, before January, we were still thinking that this year is going to be 2025 will be even bigger. Has January, the way the markets have reacted, is it tempering your expectation in terms of how many IPOs will we be able to push through? And second, do pre-IPO investors also need to temper expectations in terms of returns going forward? And what are you telling your clients?
So I want to break down this into the two parts. For investors need to understand there are two parts to the IPO. First is getting the DRHP approved.
Right.
Your DRHP approved has got direct relation to your compliances. Your profitability, for example, you are working in a certain sector, your segment profitability is 12%. If your profitability is 10%, still you can get the DRHP approved. But if your compliances are weak, Ms. Mahalakshmi, then forget your IPO. Most important, complete the compliances, which is a tougher task, and regulators have improving their making it stricter day by day, which is good for the public. I do appreciate that. So first of all, complete the compliances. That is what we do. The day I invest into any company, the most important factor in next 2 years, I take charge of the compliances, because ultimately your IPO coming or not coming, the biggest hurdle is compliances.
Right.
So once the DRHP is done, according to me, 80-90% to काम हो गया.
Okay.
Then I do agree, SIP ki amount 25,000 crore per month, it is not going to go down. Cyclically, it will come up and come down. I cannot comment on that. In large year, what is the event that are not gone against us post-corona? Corona is a gone event. There was a war in Russia. Gaza में बम फट गए. Cyclical events आते जाते हैं. But the periodicity, the length, have a trust in Indian economy. Have a trust in Indian economy. It has to bounce back. Either 1 month, 2 months, 3 months, or 4 months, not beyond that. And we are not in a product where we have to get out on Friday morning. Once you get the DRHP approved, technically you have 1 year window to get the approval. Next 1 year, we can't expect that throughout 1 year market is going to get down. That is, we are talking about a very tough situation. So that's where we play out that, okay, markets are down. For example, I'm bringing my EPC company, I just got the approval. Okay, I may not get a 30p multiple, I may get at a 25p multiple considering your market is down. But the multiple at which I have entered is 11. So I'm still in a down market also, I'm sitting 2.5 times. So ultimately, I go back to my own expectation that what is your entry level that determines the exit. I always say to all the investors, in fund management, you do not make money on the date of exit. You make money on the date of entry. एग्जिट के
Correct.
दिन सिर्फ एग्जीक्यूशन होता है.
Correct.
एंट्री
Correct.
अच्छी करो, enter well, exit is by default taken for granted, plus or minus 2 months here and there. So all the
Right.
concentration goes on the entry.
Right. Fair enough. So my question is, what kind of return expectations do you? What are your expectations in terms of what your returns could be from 1 to 3 years? And these funds are like typically, what is the tenure?
So my tenure is the regulated tenure is of course 5 years.
Yes.
From the first close, because SEBI has removed the final closure tenure, so 5 years from the
Correct.
first closing. But of course, cash flow point of view, we have a 30 months exit clause in all investments that we have done. So we always tell our investors, cyclical event will come. So assume not 30, 36. So cash flow point of view, my fund would be 3 years on a higher
Right.
side, considering the
Right.
cyclical event that you have been asking time and again.
Yeah.
But SEBI point of view, it's a 5 years. Because
Right.
SEBI calculates from the first entry and the last exit
So your 36 months can become 5 years. That's it.
on a higher side.
Right.
Don't
And
expect 2
your
years extension.
returns
Yeah,
and
sorry.
your return expectation on these products is?
So I believe that this call is getting recorded and all three will have the
Okay.
same issue. SEBI does
Okay.
not
So
permit
this is
any
no
of the
assurance.
fund
Yeah, this is
managers.
no assurance of a fund, but okay.
But the past performance has been good. The first series that we are done, we are expecting. We are recently given one exit as almost 10 times in for the first closing people, 10 times in 17 months. The second exit, I'm expecting almost close to 4 to 5 times in probably 13 or 14 months from the date of entry. Of course, I don't want to give a false expectation. Every day is not
Yeah,
a
yeah.
Sunday. But overall, the MOIC, what we typically call the multiplier on invested capital for my first series, is definitely in more than 3 times over a period of last little more than 1 year. So that
Right.
has been the story of my fund. But of course, वो बोलते हैं ना रेयर व्यू में देख के गाड़ी नहीं चलाने का. So it's the
Correct.
same way. So because this is call is getting recorded, I want to put the
Correct.
disclaimers time and again.
Sure, sure. Fair enough. So, Vicky, coming back to you, and I want to pick on a point that you talked about, that you said that, in normally on the debt that you pick up, you look at about 18 to 20% return, and anything over and above that is like an equity optionality. Is
Right.
that correct?
Yes, that's correct.
Yeah. So now I'm just wondering, how many businesses do we really have, sustainable businesses, which can afford a 18 to 20% cost of debt and still be, still see an upside in terms of equity?
So the way
I
that
mean,
you
it's from a,
no, so the
yeah,
way that you evaluate these investments is what is the size of debt compared to the cash flows that it can generate.
yeah,
The very first pillar of private credit, when I talk about cash flows, what I am looking at is that once the operation stabilizes, what are the kind of cash flows, what are the kind of free cash flows, what are the kind of EBITDAs that the company is going to generate. Will that EBITDA be sufficient to service my 18%, 20%, 22% kind of coupons on my private credit debt that I would on the debt that I would have loaded onto the balance sheet? If it
no,
can
my
only
question, the reason I'm asking this question often, and I'm today talking about everything from the prism of where we are in markets today and where the economy is right now. I mean, we are just seeing signs of a slowdown for just one quarter, maybe this quarter. I mean, we've slashed our expectations for economic growth for the
right,
coming year, and we're
right,
coming off a high. So we don't know what is in store. It is good for us to be optimistic and say that, this growth is not getting altered significantly. But
right,
in all of these products, to temper our own expectations, we need to look at what is the stress case scenario, and
right,
that's why I'm asking this question.
right.
That in India, do we have enough businesses which have such level of competitiveness or profitability that they can afford to assume a 20% cost of debt and yet be able to navigate a downturn?
Right. So, to be honest,
Because
the space that we operate in, we are in the SME segment. Our ticket sizes are such that our ideal investment would be an SME which wants to become a mid market or a large player. We don't typically target a large player. We typically target these SMEs that want to then become middling kind of players where uh, What's important is sizing the debt. If you
Hmm.
ask me, are there enough businesses in India that can service an 18 to 20% kind of a debt? There are very few businesses that can do that.
Hmm. Hmm.
The 18 to 20% coupon matters if the size of the debt is equal to the size of the revenue. If my
Hmm.
debt is only one fifth of the revenue and the margins are 15% plus, what I am looking at is essentially a 3 to 4% kind of an interest cost over an
Hmm.
annum, as against a 15% EBITDA. So
Hmm.
it is important to size your debt such that, as I said, that the debt will instill discipline. Since this company is coming off a distressed scenario, you don't want to give them free reins such that they again make reckless decisions. I mean, if you're working with the promoters, if you're yourself running the company, then you can instill everything. But if you're working with a
Yeah.
promoter, you want to instill or have appropriate guardrails such that your investment is not at risk at any point in time. We
Right.
understand risk, we understand that there is risk in every investment. What is important is how do you price that risk and how do you safeguard your capital. So
Fair
there
enough.
are these metrics that we use as our indicators when we are sizing the debt. If there is a capital required in the company which is over and above the adequate size or optimal debt that the company can service, we would, if we are gung-ho about that investment, we would take an equity call on that. So
Hmm.
every
Hmm. Hmm.
investment that we do it as a mixture of debt and equity. I mean, to
Right.
be honest, this debt and equity thesis was very relevant pre 1st February, because there the returns that are generated would get taxed in the hands of the investors as an interest income
Correct.
or as
Correct.
capital gains. Now
Right.
everything is removed for capital for Cat 1 and Cat 2. So I still have that leeway, or I use it as a lever that
Right.
I do see 18 to 20% returns guaranteed from day one for the first 2 or 3 years. And then once that debt is paid off, once it starts getting regular banking, its valuations and attractiveness to other investors will go up, which will result in returns to my equity portion.
Sure. Sure. So, Unmesh, would you like to highlight something in terms of risk in this? And you have already said that we look at this ongoing correction as an opportunity because the opportunity set is increasing and it's a good hunting ground. What would you highlight as risk and how do you cover?
Yeah, I think I, I would place risks maybe in uh, two or three buckets. Okay, one bucket is where we are remaining invested for 3 to 4 years, and as I said, the first filter is I want revenue to grow at 15 to
Right.
18 and earnings to double, right? So here, see in sectors like consumer, for example, we see that the companies tend to underestimate the investments in distribution, in marketing, in building in the dealer network. Okay, and we see so many business plans where they say that my investments will go down and the sales will go up. This never happens.
Hmm.
Uh,
Hmm.
in the healthcare sector, for example, we see that the regulatory processes, the approvals are also undermined by the managements, and we've seen lot of delays because of that. So we also have to factor in that again. It's an important pillar in the revenue growth story. On the manufacturing side, the key thing we find is companies, left, right, and center, they're expecting their margins to improve, but it's very hard to improve margins in the manufacturing sector, very hard to
Yeah.
improve
Yeah.
their working capitals. So these are risks on the business side, which is very important to be very pragmatic, to be pragmatic about. The second aspect of the risk, which we are seeing increasingly, because as we are a pre-IPO fund, but we don't exit in the IPO. Like we
Right.
exit maybe 25% of what I own in the IPO. So if I own 10% of a company, I may sell 2 or 3% in the IPO, and then I would like to sell post listing.
Right.
But we are seeing increasingly a large number of companies with financial investors who are owning a large part of the cap table. So this
Right.
supply overhang is becoming increasingly a big problem. That anywhere between 20, 30, 40, 60, 70% cap table, post listing is looking for exit in the public market, and I don't think our markets are that deep. And then you have 70, 80 IPOs coming every year, right?
Right.
So I don't think our markets are that deep to absorb this kind of supply. So increasingly, we are getting very concerned about the supply overhang and prioritizing companies with high promoter ownership. Okay.
Right.
That is a second. I think this ongoing correction is not really a challenge because, as I mentioned earlier, these cycles are short. Things can go back. They can fall back in place in as short as next 8 weeks. So I don't see this as a problem. The India story is not dented. It's a little bit of a pause, which is very healthy for deals. It's very healthy for this crores of retail investors who are buying as if there's no tomorrow. It is a
Right.
good wake-up call. It's very healthy for
Sure.
everybody.
Sure. So, Nishad, you can have the last word. How bullish are you compared to 2024 right now?
Of course, you are bullish because the India growth story is there. And again, I want to say only one thing: cycles will come and go. Don't try to chase them. Be a long-term investors. You are tend to make the money. You tend to make the money. And whatever has happened today, those who have money in hand, especially the funds like me, we are able to find something. I would not use the word cheaper because that's a wrong way, but at a good valuation.
Sure.
So
Sure.
entry determines the exit.
Sure. Sure. On that beautiful note, thank you so much, gentlemen. It was a fairly good session. I quite enjoyed it. Thank you so much for joining this evening. Over to you, Aishwarya.